Hard work is said to be the key to any excess money. At least, that's what they've made us to believe. It's a common notion that putting in the effort and working diligently will lead to financial success. You see, while hard work is very, very important, it doesn't guarantee wealth in a monetary system. The monetary system is a set of rules and institutions that govern how money is created, distributed, and used in the economy. It affects everything from the price you pay, the interest you earn, the taxes you pay, and even the opportunities we have. However, most people don't understand how the monetary system works and how it impacts their financial success. Hard work alone is not enough to achieve wealth in this system. You need to know how money is created and how it works. This knowledge can definitely give you an edge over others.
I see.
See, the famous Henry Ford once said, "It is well enough that the people of the nation do not understand our banking and monetary system. For if they did, I believe there will be a revolution before tomorrow morning."
You don't mean that!
You see, in the world of finance, the monetary system is like a puzzle and hard work is just one piece. To truly succeed, you must also grasp how money is created and how it functions. Without this knowledge, even the hardest workers may struggle to reach their goals. It's very, very obvious. So join me on this eye-opening journey as we delve into the secrets of the financial world, uncovering the mysteries behind money creation and the intricate mechanisms that shape our economy. Trust me, you seriously don't want to miss this. This is the basic of wealth with Obed. Welcome back. Let's see. An economy consists of two individuals, Mr. Johnson, Mr. Yao, and Mr. Kojo, each having 2,000 cedis to deposit in the bank. When these individuals each deposit their 2,000 cedis in the same bank, the total liquid asset in the bank increases to 6,000 cedis. However, by law, banks are required to maintain a fraction of their deposit as reserve to fulfill any potential withdrawal demands from their customers. This reserve requirement is typically set by the central bank, so let's assume our reserve requirement is 10%. By applying the reserve requirement, the bank retains 10% of the 6,000 cedis, equivalent to 600 cedis as reserve. The remaining 5,400 cedis can be utilized by the bank for lending and investment purposes. Now, consider a scenario where a businessman approaches the bank seeking a loan of 5,000 cedis for a project. After a thorough evaluation of the loan request and the borrower's credit worthiness, the bank decides to approve the loan. The bank then credits the businessman account to 5,000 cedis, creating a liability for the borrower, who is obligated to repay the loan along with agreed upon interest. At this stage, the process of money creation takes place. You see, once the borrower receives an alert indicating that he has been credited the 5,000 cedis, automatically, the total money supply in the economy expands from the initial 6,000 cedis held by the two individuals to 11,000 cedis.
He's right.
One thing is fascinating here. Banks extend loans based on the premise that depositors will maintain their funds in the banking system without simultaneous withdrawals. Basically, it's a belief. Mind you, out of the 11,000 cedis, magically, the banks still retain 6,000 cedis in customer deposit, while simultaneously having a loan of 5,000 cedis as an asset which generates interest income. And also, a 400 cedis which can still be lent out as a loan or used for other investments. It is noteworthy that the interest earned by the bank represents newly created money within the financial system. As the businessman repays the loan amount of 6,000 cedis, the total money held by the bank increases to 7,000 cedis, also reflecting the creation of new money. The process of money creation through deposit, lending, and interest income plays a major role in expanding the money supply within the economy and stimulating economic activity. You see, money is created with money out of debt, which means once money is lent out, then the creation of money has just begun. Most of the money in the economy comes from private and commercial banks, which plays major roles in extending loans to the general public. The current world economy is called the debt-based system. The term debt-based system refers to the fact that a major portion of the money supply in the modern economies is created through lending and borrowing. which means that it encourages people and countries to be in debt as it allows the creation of more money into the system. Not only that, you see, when banks create money by issuing loans, it results in the creation of debt. This debt exists as an asset for the bank and a liability for the borrower. The reason this system encourages countries and people to be in debt is not so much about bringing more money into the system, but rather about promoting economic growth and expanding economic activity. Debt allows individuals and businesses to invest, spend, and stimulate economic activity. It can provide access to capital for various purposes, such as starting a business, buying a house, or financing education. There are so many ways by which banks create money, through the process of money supply, loan expansion, deposit creation, and fractional reserve banking. But base of all this start with fractional reserve banking. That is where the creation of money actually starts from. And talking about money creation, the central bank also has an upper hand in this. They actually print money. The central bank acts as a bank for all banks. You see, when the government needs money, it typically starts by consulting with the treasury or finance industry. The treasury assesses the funding requirement for the various projects or expenses. If the decision is made to raise funds through money creation, the treasury communicates with the central bank, which is the Bank of Ghana and the Federal Reserve in the US, which is responsible for the monetary policy and managing the country's currency. The central bank, upon receiving the request from the treasury, initiates the process of creating money. The central bank then transfers the newly printed money to the treasury. The treasury then hands over the newly printed money to the government. This provides the government with the funds it requires for its project or expenses. In return for the money received, the government issues an IOU or IOU to the central bank, which is basically the government promise to repay the central bank the amount of money created, usually with an interest at a later date. The central bank and the treasury work together to manage the issuance of these IOUs. They collaborate to sell the government bonds or IOUs to investors, both domestic and international, through auction or other mechanism. This investor purchases the bonds with the expectation of receiving the principal amount and interest payment in the future. By selling the government bonds, the central bank effectively transfers the debt from itself, the investors who hold the bond. The investors become creditors of the government, and the government become responsible for repaying the borrowed amount to them according to the terms of the bond issuance. You see, one thing is very fascinating here. The central bank has the ability to remove and put money into the system, and also acts as a shield for both private and commercial banks in case there is a bank run. A situation where many clients withdraw their money from a bank because they believe the bank will fail in the near future. In other words, it is when in a fractional reserve banking system, numerous customers withdraw cash from deposit account to the financial institution at the same time because they believe that financial institution is or might become insolvent. The central bank then acts up quickly by creating money with just few clicks on the keyboard. They then use this money to buy back all government bonds or government securities in the bank as a way to put money back into the bank and increase the bank's reserve, so they don't run out of money and eventually collapse. This action, taken by the central bank, is called the lender of last resort. Bank is only a bank when there's money saved in there, and if a bank collapses, then it's just a house or a building that was once a bank. Eventually, the central bank has to put money into the bank, increase their reserve so that even in the midst of a bank run. The typical example is, during the panic of 1907 in the US, there was a financial crisis that led to a series of bank failures and liquidity shortages. Many depositors rushed to withdraw their money from banks, causing a bank run. This created a domino effect as banks were unable to meet the demands for withdrawals, leading to further panic and economic instability in the US. JP Morgan, a prominent financier and a banker at that time, played a crucial role in resolving the crisis. He organized a group of fellow bankers to provide liquidity and stabilize the financial system. Together, they created a pool of power to learn to chop banks, preventing them from collapses. Morgan's action helped restore confidence in the banking system and ultimately resolving the crisis as well. The thing is, while the central bank has the ability to create money out of thin air, it also has a limit as to the amount of money that can be created depending on the country's economy at that particular moment, as too much money can flood the system, causing inflation. You see, back in 1944, the Bretton Woods System Agreement was developed.
Bretton Woods, New Hampshire, delegates from 44 allied and associate countries arrived for the opening of the United Nations Monetary and Financial Conference.
Of which 44 countries, including Canada, Western European countries, Australia, and Japan, represented and agreed that the US dollar was to be chosen as the world reserve currency. The US economy was strong back then, the dollar was in good condition and also was worth as gold, because it was actually backed by gold, by which you can exchange a dollar for an ounce of gold. Which means, imagine our cedis is backed by gold and you can exchange a cedi for a fixed amount of gold, and the 2 cedis was worth 0.4% ounce of a gold bar. Which means, the more 2 cedis you have, the more capable you are to exchange it for more 0.4% ounce of a gold bar. So, you need more 2 cedis to get more 0.4% ounce of a gold bar to eventually get a full gold bar itself. Quite interesting and quite a process. Since the US dollar was backed by gold, the dollar was also the world reserve currency, which means every other currency that depended on the US dollar automatically was backed by gold. And every decision taken by the US Federal Reserve is like a ripple effect, comes down to all countries that depended on the US dollar. Not until 1971, the then US President Nixon, took the dollar off the gold standard.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
Which means now the dollar is backed by nothing, no physical assets, but by the futures and fees you and I have in the dollar that is worth something and that can be used as a medium of exchange, making it a fiat currency. And now that the US dollar is backed by nothing, basically all currencies that depend on the dollar are also backed by nothing, just faith and trust. Which means when our faith and trust is broken in the US dollar, the dollar collapses. When we stop believing in the dollar, it fails. You see, once the dollar is backed by nothing, the government can print as much money it wants, because if the dollar was backed by gold, then the government is supposed to find more gold to match up every new dollar printed. And since there's just nothing, then more money can be printed, thereby causing an increase in inflation, at the same time devaluing it.
He's right.
According to the 48th laws of power, law 16, use absence to increase respect and honor. It says, human circulation makes the price go down. The more you are seen ahead from, the more money appear. This law is a typical example of how inflation comes about. The more money is being printed, it causes an increase in the money supply within an economy. When there's more money in circulation, we'll have more purchasing power, which can drive up demands and prices. Look at this. Let's say there are only 100 apples available in an economy. There's a total of 100 cedis in circulation. Each apple is priced at 1 cedi. Now, the money supply suddenly doubles to 200 cedis, but the number of apples remain the same. There is now more money chasing the same number of apples. As a result, the price of each apple might increase to 2 cedis. You see, the price of goods and services will keep moving high as each and every day more money is being printed. Look, what was the price of a water bottle in 2010? How many times have you and I complained, and how many times has it been reduced? You see, it will never be reduced. Even if it reduces just a couple of months, then it moves up again. Look, it's bound to go up because more money is being printed each day. Currently, the inflation rate of Ghana is 42.2%, and banks in Ghana offer an investment rate of 7 to 10% on fixed deposits, depending on how much you are willing to invest. You see, even if you invest at a rate of 10%, you are still not ahead of inflation. As time goes on, your money loses its purchasing power, but it's also important as it gives you a slight edge over stockpiling your money in savings account or at home doing nothing. Look, why keep saving when they are always printing? Understanding that money has no value in itself, but instead it acts as a liquid and occupies the shape you give it or inherit the value you give it, will prevent you from saving up your wealth in currency. This piece of paper has no physical asset backing it, just the faith and trust you and I have in them. Which means, when this trust and faith is broken, that piece of paper becomes worthless in our hands. Instead, it's important to use that money to acquire assets that will appreciate faster than inflation. Look, it's the only way to beat the game. Actually, it's not about beating the game, it's avoiding complete loss and devastation. Have a nice day.